welcome. Thank you for joining us today for our Pension Policy Unpicked webinar. It's a real pleasure to have you all with us today. It's very much your session. We'd love you to get involved with comments, questions. We love an emoji. Feel free to put your comments into the Q&A function and submit your questions. You can find us at the top right-hand side of your screen next to the Leave button. We'll keep an eye on your comments and your feedback, and we'll have time at the end of the session to bring these questions to the fore. Today's session is being recorded and we'll be able to share the online demand with you over the next coming days. So let's get into some introductions. So for those of you who don't know me, I'm Jill Henderson. I'm Scottish Widows Head of Business Development. And today I'm joined by Pete Glancy, Head of Policy, and Ross Mackay, Head of Workplace Propositions. So before I pass on to Pete, let's have a run through the agenda and give you a feel of what you're going to get to hear about today. So we're going to start by recapping on some of the big policy decisions and changes over the last 12 months. We'll look at how that's shaping up for future change, and then we're going to think about how this affects us across the industry, employers, advisors, trustees, our whole community. So lots for us to get through. We're then going to have a panel discussion between myself, Pete and Ross, and at the end of that we'll open up for any questions that you might have, so do use that chat function that I mentioned at the start. But for now, sit back and enjoy, and we're going to hand over to Pete Glancy to take it away.
Thank you, Jill, and good morning, everyone. I'm going to kick off with a bit of a policy overview. And some of you who have seen my presentations on policy before might remember a bubble diagram where the various policy initiatives are overlaid and overlapping. But I've now split this into two. We've got a major initiative from the government called the Productive Finance Initiative. And what they're doing is they're seeing the British economy struggling post the COVID crisis, post Brexit, etc. And they're looking at ways to inject capital into our economy to get it growing again and restructuring it. They've identified as around about 7 trillion in savings and investments in the UK, around 2.5 to 3 trillion of that sits in pensions, and there are multiple initiatives spanning many aspects of pensions policy which are geared towards getting some of that money in the pensions ecosystem investing in ways which the government might consider good for our economy. Patriotic investing, if you want to give it a sort of name. The Productive Finance Initiative itself is initiatives which are really directly about trying to get that capital in. So we've got the new Long-Term Assets Fund. The government floated some kites in terms of raising funding specifically for the science and technology sector, the LIFTS initiative. And then you'll also be aware that a number of companies, including ourselves, have signed the Mansion House Compact. What the Mansion House Compact does is it's a commitment on our part to move some money in default funds by the year 2030 into illiquid investments. Those investments could be anywhere in the world. Obviously, the government would like to see them in the UK, but only if that can be demonstrated to deliver an upside for customers. So I think it makes sense to sign that because it allows us to have very detailed discussions behind closed doors to explore whether there are win-wins that we can find for customers. If there aren't win-wins, at least we had a go, but it's too big a prize not to take the opportunity to see other win-wins that could be had. The other initiatives, many of them started their life as something else, but as I say, they've been hijacked, I hope that's not too strong a word, by the productive finance agenda. Collective defined contribution really started its life as something to help employers with DB schemes move away from DB into something that wasn't quite as risky from the perspective of members as DC, probably aimed primarily at public sector or pseudo-public sector organisations. But the government spotted or has been persuaded by some of the actuarial consultants that CDC is a type of pension that may be more conducive to investing in long-term assets, potentially here in the UK. So we're now able to do whole of life CDC schemes, and the government is now talking about, will we in the future have decumulation only CDC schemes? I'll come back to that a little bit later. Solvency II reform is designed to lift some of the burden on people like insurers so that there isn't an actual capital strain if you're doing the less liquid investments. The value for money framework that's being discussed by the regulators and DWP, originally aiming to get a single basis of comparison so that people can compare like for like value for money across all of the different types of workplace and individual pensions. It's now very much being driven as a battering ram, to reduce the number of schemes in the market, with the belief that a smaller number of D schemes will lead to a smaller number of very large default funds, and those large default funds will have a capability to invest in the sorts of liquid assets that the government would like to see. There are other aspects to it. I'm just bringing out the productive finance elements. And then in decumulation only, the DWP, in terms of the trust-based world, are looking for trustees to be putting in support arrangements and product solutions for people approaching retirement in terms of the decumulation vehicles that they will go into. The government steps back from mandating that CDC should be part of that suite of support, but they are very much looking to promote CDC as part of that environment. And again, I'll come back to that later on. We have the Small Pots Initiative. Again, this is really about tidying up the tens of millions of very small pots we'll have by the middle of the next decade, getting that down to a manageable number, driving efficiency for the industry, but also making it easier for individuals to manage, 10, 20 pots that they may have if they move around a lot. But again, that's slightly being driven now by the productive finance agenda, trying to get solutions that crash the pots together in ways that may make it easier, to get those assets investing in the ways that the government would think are attractive. And a new one that came out very recently, it was developed in the spring and rolled out by the Chancellor in July, a consultation for trustees in terms of, how do they really have the competency and the understanding. But I think what they're really questioning there is, are there things about the fiduciary duty that are stopping people from investing the way that the government wants, which I think doesn't quite get the point of the fiduciary duty. It's there to ensure that the members' interests come first. So that'd be an interesting one in terms of watching the politics of that. Away from productive finance, the self-employed is still a big challenge. 4.5 million self-employed people. The government's reawakening its working group on self-employed. It had gone cold as the lockdown started, and it's just been reawakened. No new news there, but it's still a priority. We're expecting a consultation or discussion paper to come out probably about before the end of the year on something that we're calling Auto Enrolment 2.0. So in there we'll have the sorts of dates at which the age might come down from 22 to 18 and when band earnings will be removed as a basis, but we're also expecting a discussion of what's next beyond 8%. How and when do we get up to the required level of savings? And it's also likely, I think, that we'll see a consultation on, is auto enrolment extended beyond just pension and retirement savings to include rainy day savings, the sidecar initiatives that Nest have been trialling, for example. There's some conversations around from the FCA around the CRIPS world. Should some of these more exotic assets continue to be included in the Financial Services Compensation Scheme? There's a whole world of stuff going on engagement. MAPS have rolled out a midlife MOT, and they're now working on a later life MOT, which will look at your financial position much more holistically as you go into retirement. Dashboards, as we know, have been delayed a bit. There's still massive momentum behind it. They will come. It's just proving a bit more difficult than we thought to deliver as a country. And I think we'll see the first dashboards in 2026 now. But the momentum is still there. It's just taking a bit longer. Open finance will follow behind that. I'll touch on that later. And then we're also expecting a discussion paper very shortly from the FCA on how we go about closing the advice gap, and I'll touch on that later. Finally, on taxation, we saw changes and reforms in the budget to the money purchase annual allowance and the lifetime allowances. Labour Party have said they'll reverse the lifetime allowance. I don't think that'll happen. When they get their hands on the numbers in the Treasury, we'll see that in the long run, people having bigger pension pots and paying much more tax, it's actually going to generate income for HMRC rather than take money away. There is a potential for the Labour Party to reform some of the inheritance tax side of things, so that's maybe resulted from that. And I don't think that pensions reform itself is completely off the table. There's something like 60-odd billion of pensions tax relief, and they get about 30-odd billion back. Pensions and payments, very ballpark there. But the Labour Party think that too much of that relief goes to the wealthy, and I think the Conservatives think it's just too big a bill. So it's not off the table, but I don't think we'll see it in the manifestos. Moving on to the Value for Money initiative, a couple of slides on this. We've all responded to the consultations. Government's setting up a number of working groups to look at charges, investments, service levels, and also the overall governance, the RAG status, and what happens if you're amber or red, etc. Those working groups will be launching over the next couple of months. They'll include the trade bodies. I've been invited by the FCA to be involved as well, so I'll be able to report back as that continues. One of the big challenges on charges that we'll have is we've got really three types of product if we're thinking about charges. We've got monocharge, which many modern GPPs and master trusts operate, whereby different employers might pay a different charge based on the nature of their workforce and the average pot size that might accumulate. But each employee within a workforce will pay exactly the same percentage charge. So that's monocharge, and I think the way to look at that will be by cohorts. We'll maybe bunch together employers of certain numbers of employees or certain numbers of asset managements and try to compare on a like-for-like basis across cohorts. You've then got the dual charge arrangements where you're charging maybe a pounds and pence fee and an annual management charge, or you're charging a percentage of the contribution in an annual management charge. Those schemes are able to say to each employer that each employer has the same charging structure, but how that then plays out is that each employee within the workforce experiences a very different percentage charge. And you can see on the diagram there the range of charges that people could be bearing based on basically based on their pot size over time. And then the multi-charge, which are really the legacy pensions that were designed before 2001, you could have 5 or 6 different types of charges there. They not only vary from one member to the next within a scheme, but they can vary from one member over time, and they can also vary based on the amount of activity that people are doing within their scheme, switching, etc., or asking for additional statements. So it's very difficult to compare the charges. On the investment side, we know some pieces of the jigsaw, but a lot of it is still to be worked on through these working groups. On investments, we know that we're going to be asked to have a backward-looking look at performance over 1, 5, 10, 15 years, etc. The emphasis will be on comparing value for money on 5 years plus. We'll look at the shorter durations, but the longer durations are where VFM should be judged, because the shorter durations will have that volatility. Within the metrics, it won't just be the absolute level of performance net of charges. They're also introducing a couple of metrics that look at volatility, annual standard deviation, and max diff. The reason they're doing that is that if you're investing in less liquid assets, potentially here in the UK, that gives you more diversity away from shares and bonds, and it also tends to be a bit less volatile. So you can see that they're nudging the way that this is measured in a way that will maybe nudge people towards investing in the way that the government wants. They want to look at forward-looking investments, despite the fact that it's very difficult, to do that without gaming, and they've asked the Government Actuaries Department to come up with an objective basis on which we might be able to project future returns based, I would expect, on asset allocations. They've said very little on service so far, but we know that they're going to measure service mainly around the financial transactions, money in, money out, and fund switching to make sure that it's done timely execution. But they're also looking at customer outcomes, and I think where they'll probably get to there is something that's based out of a standardised, external, independent customer satisfaction survey. So scheme providers will need to provide big files of scheme member contacts, and somebody independent will conduct a satisfaction survey. And it might be things around, are you getting the information from your scheme that enables you to make the decisions around your retirement, for example. The charges and the value for money stuff itself, I touched on the fact that it'll probably have to be done on cohorts. It's going to be really, really difficult to find a way of comparing like for like across the monocharge, the dual charge, and the legacy. So that might just be tough enough to crack, but we'll see. Schemes will have to come up with a RAG status each year, red, amber, and green. The proposals are that if you're red for 2 years running, you will need to wind up and join a multi-employer scheme, whether that be another GPP or a master trust, depending on which regime you're operating under. And scheme consolidation, if you want to be a consolidator receiving those schemes that are winding up, that will become a regulatory permission that you'll need to apply for. You'll need to demonstrate scale, fit and proper persons, but also that you'll deliver value for money, which I think is code for investing in the way that the government thinks is good for people in the long run. I'm moving on to a combination here of the consultation on decumulation and CDC. So I think it gets very, very complicated when consulting actuaries are putting out all these CDC proposals. And what we're trying to do here is simplify it right down, partly to articulate the challenge, and also because we're doing a massive piece of research around this that we'll be able to share with you later in the year. We'll be able to tell you what the customers want in terms of decumulation. But there's really 3 broad spectrums, if you like, in decumulation. One of them we've got here is the x-axis, which is control. Do you want to cede control to your pension provider, i.e. purchasing an annuity, or do you want to retain control and on all of the complications that come with that, but get the flexibility? That's kind of income drawdown. There's then another big axis, which is the y-axis, which is, do you want a consistent income through your retirement, which might be akin to with profits, or do you want that to fluctuate, or are you happy for it to fluctuate, potentially to get a bit of upside? It's not guaranteed upside, but potentially, and that might be unit linked. And then, of course, there's quite an emotional piece here, which is why a lot of people moved away from annuities. You know, if you were to pass away earlier in your retirement, how important it is to you that you're able to pass some of that money on to the next generation versus not? If you look at the two products in the market, the reason I've done this as a three-dimensional cube is because there's 8 points on a three-dimensional cube, and we can then map products against it. Standard annuities fit in that top corner there, and income drawdown fits in the bottom back corner. And most of the conversations is if people want something in between, then you use guidance and advice, etc., and you give them a mix and match between the two products. There's also another product on the market. Only 3 to 4% of annuities are sold on this basis, but you do get unitized annuities, whereby you could potentially get a bit more income through your retirement, but you would have to accept the fact that because it's not smooth on that y-axis, that your income could go up and down. And then we have the proposal for a decumulation only CDC, which also sits in that bottom front corner. So that throws up two questions. One is, why would you launch a product into the market where there's already a product in the market? And if the product that's in the market doesn't really sell very well, why would you choose to shape decumulation only CDC in exactly that way? So what we're doing, as I say, is a massive piece of customer research to try and find out where customers sit on those three axes, and then which of the three axes are most important to them. That will help us inform the development of our propositions and support in future, but also enable us to inform the government in terms of their thinking. The second half of that decumulation consultation from government, we're still expecting it. The first half was looking at products. The second half is looking at how we engage people. They're not going to copy what the FCA has done in investment pathways, because the investment pathways from the FCA really looks at what people are doing with their pots. So you ask people a few simple questions around what they're doing with their pot, and that leads to an asset allocation where the money in that particular pot is invested in a way that will give them the best outcome on average. The alternative hypothesis, and again I'm speaking to DWP about this next week, is not to talk to people about what they're going to do with their pot, but to talk to people about what they're going to do with their retirement. So are you going to use the money to bridge your retirement date through to your state pension? Are you going to work state pension and need to use it as a top-up? I won't read them all, but I think you get the gist, that if you're having a conversation with people about what they're going to do with the rest of their life, you could get to a more meaningful suite of outcomes and support that schemes would be able to offer. We're getting, as I mentioned earlier, a discussion paper or a consultation from the FCA and the Treasury very shortly, we think. We're involved in the pre-consultation work. We're supporting the thinking on that. We're expecting a 2+2 model to come out, and they'll ask us all what we think about it. So there'll be two guidance, two advice options. So we know what guidance currently looks like, but there may be an option that allows us to go a little bit further, either in terms of being proactive or in terms of making it more personal. The other option they're looking at is what we call a choice architecture, which basically looks a bit like investment pathways in terms of methodology. You ask a bunch of simple plain English questions, you put it through a predetermined algorithm or roadmap signed off by the regulator, and it comes out with what might be a more complicated answer. So it can be used, that idea or that concept, in other parts of the retirement planning journey and decision-making processes. So that choice architecture will continue with full-fat advice pretty much as it stands, but also a proposal on a lower cost advice model, potentially with lower qualified people, answering specific questions rather than looking at your entire financial circumstances and only being liable in terms of the way you answered that specific question. You're not liable if you missed something that wasn't included in the question. The last area, just 2 slides, is that we're on a journey to something called open finance. This is going to become really, really, really big for all of us, whether we're pension providers, employers, or financial advisors, or EBCs in the future. Started off with open banking. We've obviously been involved now as a broader group. whereby you can log on to one bank, one place in the digital ecosystem, and then see all of your banking, core banking products in that place. Pension dashboards could also become called open pensions. It will allow you to log on somewhere and see all of your pensions in one place. A trade body called TISA working on open savings and investments, but open finance itself will include all sorts of stuff like general insurance and mortgages and credit cards and loans. So in the future, tech-orientated companies, which could be us, or it could be an Apple or a Google, tech-orientated companies will be able to present to people all of their personal household financial propositions in one place. So you've got aggregation. They may then help them make decisions, which is guidance and advice, and they may then enable them to execute those, which is transacting. And then if you go beyond open finance, you could pull in other data, such as the shopping data from Amazon, or the browsing data from Google, or the data from utilities companies, and then you get into a world of open data. The FCA are starting to think about this now, because we don't just want this thing to run away and create all sorts of unintended consequences for the country and our industries. We need to make it sure it's safe and secure. So I think the general idea is that there'll be a perimeter around this. And if you want to provide one of these open data or open finance services, you'll need to apply for a new regulatory permission that allows you to do so. Fit and proper persons, all the rest of it, holding capital for redress. There will need to be an authentication regime which allows you to log on, and once you're authenticated, you can do the whole experience without having to authenticate yourself at each individual firm you move on to. The financial services companies will be mandated to put their data on the table. There will probably be a consents hub where you sign up to say, I allow my data within this ecosystem to be used in different ways. So I don't want my claims data or my health data being used, but I'm happy for my banking and shopping data to be used, etc. So you'll do consents at different levels. And then a massive concept for us is called reciprocity, whereby if the Googles and the Amazons want to come and play, they need to put their data on the table too to get into the ecosystem. Because if we don't do that, British financial services will put all their data on the table. Amazon and Google will combine it with their data, which isn't on the table, and you're just transferring value from UK financial services to American big tech. So we need to get that principle of reciprocity. So that's a quick counter through for me. There's an awful lot on the go. I was just trying to get the highlights out there quickly. And now what I'm going to do is ask Jill and Ross to join me, because what we want to try and do is just get a bit of a market perspective from Jill in terms of what she's seeing out there, speaking to clients and advisors, and also Ross in terms of what are we doing in terms of our roadmap. Some of these things are early stages, some are more advanced. So let's see. But if we start maybe with the value for money framework, I mean, there's a lot to be worked through. We've still got to get these working groups up and running to get an awful lot of the detail. But this has been talked about quite a lot, Jill. What sort of things are you seeing in the market? What do you think the implications could be?
Well, firstly, thanks, Pete, for a great session. That was fab, and I'm sure the audience got a lot from it. Yeah, value for money is definitely a hot topic, as you've said. I would probably start with charges. So for me, a lot of focus has been around how we charge on products and the cost of pension policies. And I think what we've seen across the board is the pricing gap narrow. So there's been a downward trajectory, which is great. It means that we're more cost effective. Members are getting better value in that sense. I think there was some data shared by Broadridge, which looked at the average basis point on a scheme moving from like 76% down to around 39. So there's been a shift, which is great. There's also a lot more to value for money than just cost, though. Lots of different factors that we need to bear in mind so that we can give good quality, be constantly innovating and creating new content to keep members engaged, as an example. So whilst price is important, it is important also that we keep room so that we can continue to invest in proposition and growth and so on. So that's an element for me. The other point, of course, is investments, and you touched on both the charge and investment piece. It's been quite a challenging period for markets, certainly in 2022, certainly from Widows' perspective, and a much more positive note. Last year's performance has been super. Over a longer period of time, we've got great performance on a default as well. And employers and advisors are looking at that too, which is the right thing to do. So as long as we create an environment where we can be flexible and continue to innovate, I think that value for money just needs to be in that context. That would be my view from what I see in market.
And Ross, from a roadmap propositional point of view?
Morning, everyone. So I guess, I mean, the key point here is Investment performance, charges, service are always been the cornerstones here. But getting members really engaged in their pensions is important, and getting them to pay in early is incredibly important. It's probably going to have the single biggest impact to their retirement. So Pete, you mentioned that proposed extension to auto-enrolment. That's a massive positive for the industry. But if we think about engagement and getting people engaged, actually to do that at scale, digital is incredibly important. So if we think about us as an organisation, one of the things that we're doing is investing heavily in digital. So for example, this year alone, we've added 7 new significant features to Scottish Widows app, and that's included completely redesigning the journeys around fund switching, around pot consolidation. And as we've done that, we've really thought about the barriers to member engagement, making sure that we've got high digital accessibility standards in there. And on the back of that, what we're starting to see is the benefits. So in the last year, we've had a 50% increase in app registrations, and now we're getting market leading app rating. If we think about value for money in the new consumer duty framework, we're definitely headed into a marketplace where differentiation will be about outcomes. If I give you a wee example from our proposition, so we've just rolled out a new video benefit statements, and as part of this, we added in personalised nudges. And as a result, over 60% of the members that are viewing those videos are taking some sort of positive action. That might be nomination of beneficiary or increasing their contributions, but we're seeing real positivity on the back of that. And I think for providers like ourselves and for the wider industry, that's the sort of thing that we need to start demonstrating as we're making investments.
Thank you. And I should just say to viewers, I've got a few more questions for Jill and Ross, but if you do have any questions of your own, pop them in the chat there, and we'll get to those in a moment or two. So another big initiative, and this is the one I touched on up front there, the government's really focused on this productive finance initiative, using more liquid assets in portfolios, and hopefully using more UK orientated assets, to create a virtuous circle. How are you seeing that playing out in the market, Jill?
Well, liquids are definitely the hottest ticket in town, aren't they? It's lots of discussion, everyone's involved, different thoughts. It's still in its infancy, would be my observation, and the demand is yet to sort of crystallise in terms of new schemes. It's probably going to be somewhere like we were with the ESG a few years ago, where it will become a requirement. What's going to be really interesting is to see how people respond in terms of cost. There will be a cost for this type of investment option. And will people be prepared to pay 5, 10, 15 basis points, depending on the offering that is being put forward? So there needs to be a reasonable thought around the cost and what's the right fit for the employer. And from my perspective, it's important that there's choice. So there is a liquids element, but we also have other options, so you're getting exactly the right fit for that employer and their membership.
Thank you. And Ross, is it too early to comment from a propositions perspective or not?
No, I think we can. I mean, Pete, I think the next decade is going to be massively interesting. So you've got major economies moving towards net zero. And if you think about it as a major economic transition, I mean, it's probably one of the first, at least in modern time, that's driven by need rather than technological innovation. So it's potentially more complex, more uncertain than something like the digital revolution, where quite a lot of the technology you could see where it was coming from. But for me, opportunity and risk management are going to be incredibly important as we head into this journey. So from our perspective, we need an investment solution that can continue to evolve, especially around net zero. So if you think about the things that are going to power net zero, it's going to be innovative growth capital, it's going to be infrastructure investment. That's the things that we need to think about and how we incorporate them into our strategies. Okay, so what we're going to do about it? Well, we're looking to introduce a new default solution in 2024. This will have an allocation to liquids, and it will also have a to and through investment design. As part of this, Pete, you've already talked about the fact that we signed up to the Mansion House Compact, and we know there's going to be interesting opportunities in the UK, but we know there'll be interesting opportunities internationally. Importantly for me, even with this commitment, we're absolutely going to be investment-led. We're going to do the right things for the end members.
Thank you. So moving on then, we've got CDC as another major topic. So we've now got legislation in place that allows people who want to set up a CDC scheme or a multi-employer CD scheme, a whole of life, and the government's, I think it's a good few years away if it does happen. The government is talking about a decumulation only variant. Are we seeing demand from clients for CDC, Jill?
I would say there's, again, more of a discussion point and it's seeking to understand the actual demand for creating new policies and new products. There's been very little of that. Certainly there's been question and discussion, as I said, but we've not seen a flurry of people looking to explore this and bring that into their arrangements. It's definitely got the potential to help us as an industry. I do have a question around customer appetite and also customer understanding. We've talked a bit about engagement and people understanding their pension arrangements and how complex this could be and could be perceived to be. So it'll be really interesting to see how it evolves over the coming months.
Okay. And Ross, I mean, whether it's the whole of life CDC or whether it's decumulation only, does any of that have attraction to us at this point in terms of our proposition roadmap?
Yeah, I think, I mean, Pete, all of this is interesting and, as Jill said, has the potential to really help industry. The thing that we're trying to understand, and you touched on it in the slides that you covered, Pete, is customer appetite. So we started this process around doing some deep research in this area. So it's too early to go through that research in detail, but I'll just touch on some of the kind of key themes that are coming out of that. The first thing, and not unexpectedly, people are confused, they lack product knowledge, they're stepping into the unknown. And this is just another indication that as a sector, we have to step up in what we're doing. We have to simplify the communications to members. We have to think about how we respond to the new consumer duty and make sure that customers actually understand this as a product. The second thing we've been asking about is, with a choice of annuity, drawdown or CDC, what would be customer preference? And currently in the research, very early days, but there's no winning option. So we're going to try and unpick that and ask the questions in different ways to try and help customers understand what that could mean for them. You also covered this, the kind of third theme in your slides as well, Pete. The idea of not passing on pots can kind of trigger this feeling of guilt and loss is coming up quite strongly in the research. And I think that's quite differential depending on what customer base you're talking to. Quite a lot of customers still actually have quite big financial commitments going into retirement. That might be children that are still living with them or a partner that they have to support. So they have to think about that as well as they're thinking about the retirement solutions. The last area, and this links to what you've been talking about, open finance. Pension products are a complex picture, but it's part of an overall financial story that the member has to consider. So making decisions, it's hard to make those decisions in isolation. They actually need wider support to make the decisions around what they're going to do in retirement, considering property and other elements of their financial capital. So as we said, very early days for the research, but we'll publish a more detailed analysis later in the year.
It sounds like not a silver bullet, but we're looking to look at different cohorts of customers and come up with things that meet the needs of quite a broad spectrum of people. Yeah,
I'd completely agree, Pete. I think it probably will end up like that. We're going to need to get into quite personalised cohorts of customers and understand their needs. But I think the key thing is actually having a range of solutions for our member base makes sense. It's just whether there's enough of an appetite for CDC to make it work.
And just finally, I mean, you touched on open finance there as well, and maybe just touch base with Jill on this. It's a very broad, multifaceted. We don't know exactly, which direction it'll end up going in, but it looks fairly fundamental, using digital to bring together all these different pieces of financial jigsaw, and it could impact the role that we play, how employers engage with their workforces, the role of advisors, etc. Are you hearing much chat about open finance out in the market, Jill?
Yeah, for sure. And I think you touched on financial wellness as a key theme of that in your presentation earlier, which is not a surprise. Goodness, if you think about the last few years we've been through, we've had COVID, we've had governmental change, policy change, all of that impacting economics and people really feeling that. So the need for financial wellness and having a connection to your pension arrangement has never been greater. So actually the appetite is bigger than ever, and this will become, I think, more of a hygiene factor, just a thing that you need to have as part of your pension arrangement to make sure your membership's really engaged. We've done a number of sessions just like this, but with our employers and members through various webinars, and the appetite's been massive. We've had 700, 800 people dial into these calls because they're keen to learn more, which is super. And at the end of last year, we launched our Be Moneywell financial wellbeing site, and we've had over 100,000 views to that site. So there's definitely an appetite, there's a need, and that's something that we're really well placed to support, which is super. Obviously, being part of Lloyds Banking Group, we have the functionality through the banking app, which you've mentioned. So that whole part of being connected, having that pension in your pocket, is definitely a helpful factor as well. And people are seeing their pension details in the palm of their hand, daily, weekly, monthly, much more regularly. So that's definitely a positive. But to answer your question, it's a market theme I expect to continue to grow, and I look forward to the continued innovation that Scottish Widows are going to bring.
And Ross, just in terms of that whole journey, what's on our roadmap and our thinking so far?
Yeah, so there's quite a lot in this one, Pete. I mean, as a sector, I think this is where we can knock it out of the park and actually really drive some innovation into the propositions. I think there's a huge opportunity here. And I think the opportunities around initial engagement to hook more people into their pensions, but also to deepen ongoing engagement with both financial wellness and open finance. And the way that we're thinking about this is sort of three things: just helping people get started on their financial wellness journey, and then giving them the support and the education they need to upskill themselves, and then giving them an ongoing platform to manage all their finances in one place. So if we start with that first bit, I mean, to help members get started, we've developed a financial wellness diagnostic tool, and that just helps them get started on the financial wellness journey. It's been developed by the behavioural science team at Lloyds and asks about 15 to 18 questions across all areas of your finances. Then gives you an output. It benchmarks you in 4 kind of key categories. One, for example, sort of day-to-day finances. And then the really important thing, it gives you an action plan on the back of that. So next best actions to improve your financial wellness. Some of that's pointing to our educational content, but some of it will also encourage you to do things like nomination of beneficiaries. Jill talked on the second aspect, which was around the educational sports. We launched the Be Money website. We've had incredible engagement with that already. We'll continue to develop it. We'll soon be adding in a financial wellness blog there as well. But the last element, and the bit that's really exciting and important for me, is having all your finances in one place. And this is the thing that comes out time and time again in our customer testing, that members want support in this area. So what are we going to do about it? Well, we're integrating an open finance solution into our app, and that'll be launching over the next few months. That will allow members to see all of the finances in one place in our pension app, covering open banking, pensions and investments. And over the next few years, we're going to really build the features around this, building it towards a holistic personal financial management proposition. And practically able to do, we will integrate a commercial dashboard into the experience. But overall, Pete, I think this is the area that the sector can really innovate, and hopefully we can start really breaking the engagement challenge on the back of it.
Thank you. I'm just going to hand back to Jill in a second, but before I do, it was a very quick count through a massive policy agenda. Hopefully it's given you a flavour of what's going on. If there are areas that are of particular interest to you and that you'd like us to come and speak to you in more detail about, let your appropriate account manager or client manager know, and we'll be happy to do that. But Jill, I'll hand back to you to see if there's any questions from our audience.
Brilliant, thank you. Yes, we have got a number of questions. We've probably got time for a couple. So, Pete, if I come to you first, please. Scheme consolidation, is scheme consolidation to become a regulated permission? Will this also be the case for defined contribution market, trust-based and or contract-based for providers and or EB consultancies? Can read that out again if that would help.
No, that's fine. Yes, I mean this is a proposal, so in a consultation, so not everything in a consultation comes to pass. But yes, the idea is that if you want to be a consolidator of pension schemes, so whether it's an occupation, well, it'll be a multi-employer occupational, it's basically a master trust, whether it's run by an insurer or an EBC. You would still have to apply for the permission. And for contract-based schemes, yes, I mean an insurer has a GPP is a multi-employer scheme. It's you have a single approved personal pension scheme, which includes individual pensions and group personal pensions. That scheme would need to apply to become an approved scheme as well. Yeah, so it would apply to absolutely everybody operating a trust or contract-based scheme that wanted to be a consolidator. I think it will work in a very similar way to the master trust approval process, but it'll be distinct from that. And as I mentioned, there'll probably be an emphasis on how are you going to invest that money if we give it all to you. And the government may be twisting your arm a little bit. So.
Brilliant, thank you. We've probably got time for one final question before we wrap up, and also come to you. This is with regards to the default fund and how we see this working. Do we see this sitting alongside an existing one or replacing an existing one?
Yeah, I think we see it sitting alongside our existing one, so it all has to work together. So I think it'll be optionality. So I think there'll be some schemes that will want a liquid investment, so will be willing to pay that additional 5 to 15 basis points, and then there'll still be an area of the market that won't be palatable. But I think the key thing is it all has to make sense in terms of net zero, the transition, and the opportunities that we are delivering for our end member base. But absolutely, they'll sit alongside.
Brilliant, thank you. Well, I'm going to wrap us up now. I'm conscious of time. I'd just like to give a huge thanks to Pete and to Ross for delivering our session today. Thank you both very much. Hopefully you can see a QR code on your screen just now. We would really love it if you could scan this onto your phone and give us a bit of feedback on today's session. It'll help us planning for future webinars. We want to make sure that they're really relevant and they talk to things that you're interested in. So please do take a moment to scan the QR code and give us some of your feedback. Thank you all for attending today. It's been brilliant to have you with us. As I mentioned at the start of the session, today's call has been recorded, so we'll be able to share it with you, and you can also go onto our Scottish Widows Advisor webpage in due course as well. Thank you again. It's been lovely having you with us, and hopefully we'll see you in a future webinar soon. Thank you.